Have you ever wished for a money-making machine that works for you even while you sleep? That's the magic of compound interest. Imagine your money growing, not just on your initial savings, but also on the accumulated interest. That's what makes compound interest so powerful. Over time, even small amounts can grow into substantial sums. This snowball effect is what makes compound interest a game changer for building wealth. The longer you let your money compound, the more dramatic the results. Let's break down the formula for calculating compound interest. A equals P times 1 plus R over N to the power of NT. Don't let the equation scare you, it's simpler than it looks. A is the final amount, P is the principal, R is the annual interest rate, N is the number of times interest is compounded per year, and T is the time in years. Let's plug in some numbers to see how it works. Suppose you invest $1,000 for 5 years at 10% interest compounded annually. After 5 years, your investment grows to $1,610.51. That's the power of compounding at work. The frequency of compounding plays a significant role in how quickly your money multiplies. Compounding can occur annually, semi-annually, quarterly, monthly, or even daily. The more frequently interest is compounded, the faster your investment grows. Let's compare two scenarios with the same initial investment of $1,000, a 5% interest rate, and a 10-year investment period, but with different compounding frequencies. Scenario 1, annual compounding. A equals $1,000 times 1 plus 0.05 over 1 to the power of 1 times 10, which equals $1,628.89. Scenario 2, monthly compounding. A equals $1,000 times 1 plus 0.05 over 12 to the power of 12 times 10, which equals $1,647.01. After 10 years, the investment compounded monthly earns you $18.12 more than the one compounded annually. This difference might seem small, but it highlights how compounding frequency contributes to long-term growth, especially with larger investments and longer time frames. The takeaway here is clear. The more frequently your interest compounds, the more you benefit from the magic of compound growth. While the difference might seem insignificant initially, it can have a substantial impact on your investment returns over the long run. Want a quick and easy way to estimate how long it takes for your investment to double? Look no further than the Rule of 72. This simple rule is a handy tool for investors. The Rule of 72 states, divide 72 by the annual interest rate to determine the approximate number of years it'll take for your investment to double. For example, at a 6% interest rate, your money will double in approximately 72 divided by 6, which equals 12 years. At a 10% interest rate, your money will double in approximately 72 divided by 10, which equals 7.2 years. While not perfectly precise, the Rule of 72 provides a helpful guideline for understanding the impact of different interest rates on your investment timeline. Keep in mind that the Rule of 72 is just an approximation. The actual time it takes for your investment to double will depend on the specific interest rate and compounding frequency. However, this rule offers a quick and easy way to grasp the concept of compound growth and its potential impact on your financial future. Section 5. Early birds get the wealth. Time is your greatest ally. When it comes to compound interest, time is your greatest ally. The sooner you start investing, the more time your money has to grow exponentially. This is especially true for younger investors who have a longer time horizon. Let's say you start investing $5,000 annually at age 25, earning an average return of 8% compounded annually. By age 65, your investments would grow to approximately $1.3 million. However, if you delay investing until age 35, even with the same annual contributions and returns, your portfolio would only reach around $570,000 by age 65. The lesson is clear. Starting early allows you to capitalize on the snowball effect of compounding. Even small contributions made consistently over time can lead to significant wealth accumulation. Don't underestimate the power of starting early. The earlier you begin, the more time your money has to work its magic and grow exponentially. Section 6. Factors influencing your compound interest journey. Several factors influence the rate at which your money compounds, including 1. Interest rate. The higher the interest rate, the faster your investment grows. Even a small difference in interest rates can significantly impact your long-term returns. 2. Compounding frequency. As discussed earlier, the more frequently interest is compounded, the faster your investment grows. 3. Time horizon. The longer you stay invested, the more time your money has to compound and generate exponential returns. Time is your greatest ally in maximizing the benefits of compound interest. Understanding these factors is crucial for making informed investment decisions. By carefully considering these elements, you can develop a tailored investment strategy that aligns with your financial goals and risk tolerance. Remember, compound interest thrives on consistency and patience. By staying invested for the long term and making regular contributions, you can harness the full potential of compound growth and watch your wealth flourish over time. Section 7. The silent thieves' fees and inflation. While compound interest is a powerful wealth-building tool, it's essential to be aware of factors that can erode its benefits, primarily fees and inflation. Investment fees. Various fees can eat into your investment returns, including expense ratios. These are annual fees charged by mutual funds and exchange-traded funds, ETFs, to cover administrative and management expenses. Trading commissions. These are fees charged by brokers for buying and selling securities. Advisory fees. These are fees charged by financial advisors for their services. Inflation is the rate at which prices for goods and services rise over time, effectively decreasing your purchasing power. To mitigate the impact of fees and inflation, carefully research and compare investment options, choosing those with low fees and a solid track record of outpacing inflation. Remember, even small differences in fees can significantly impact your long-term returns. By minimizing fees and accounting for inflation, you can protect your hard-earned savings and maximize the benefits of compound interest. Section 8. Practical tips to harness the power of compounding. Ready to put the magic of compounding to work for you? Here are some practical tips. 1. The sooner you start, the more time your money has to grow. Even if you can only invest small amounts initially, consistency is key. 2. Make saving and investing a habit by automating regular contributions to your investment accounts. 3. While higher returns often come with increased risk, it's essential to strive for investments that outpace inflation and generate substantial long-term growth. 4. Carefully research and compare investment options, opting for those with low fees to maximize your net returns. 5. Reinvest any dividends or capital gains back into your investments to further amplify the compounding effect. 6. Compounding takes time, so be patient and avoid making impulsive investment decisions based on short-term market fluctuations. Remember, building wealth through compound interest is a marathon, not a sprint. By adopting a disciplined approach, investing consistently, and staying the course, you can achieve remarkable financial success over time. Section 9. The two sides of a coin. Pros and cons of compound interest. Like any financial strategy, compound interest has its advantages and disadvantages. Compound interest allows your money to grow at an accelerated rate, generating significant wealth over time. As your investments compound, they generate passive income through dividends, interest, and capital gains, helping you build wealth even in retirement. Investing in assets that outpace inflation, such as stocks and real estate, can help protect your purchasing power over time. Compounding takes time to work its magic. Short-term investments won't benefit as much as long-term ones. Investment returns are not guaranteed and can fluctuate due to market volatility, potentially impacting your compounding returns. It's essential to resist the urge to withdraw your earnings prematurely, as this can disrupt the compounding process and hinder your long-term growth. Understanding the pros and cons of compound interest is crucial for making informed investment decisions. While it's a powerful tool for wealth creation, it's essential to be aware of its limitations and adopt a long-term investment horizon. Section 10. Conclusion. Embracing the long game of wealth building. Compound interest is a powerful force that can transform your financial future. By understanding its principles, starting early, investing consistently, and remaining patient, you can harness its magic to achieve your financial aspirations. Remember, building wealth through compound interest is a marathon, not a sprint. Embrace the long game, stay disciplined, and watch your money grow exponentially over time. By making informed investment decisions, minimizing fees, and staying committed to your financial goals, you can unlock the true potential of compound interest and pave the way to a secure and prosperous future. Section 11 disclaimer: I am an AI chatbot and cannot give financial advice.